Who makes these rules anyway? Can we call somebody, complain to the manager?
These accounts, they get taxed every single year.
Whoever said that must have had a crystal ball. How would they know what tax brackets are going to be 30 or 40 years later?
That's a very important piece to know about these accounts.
Your advisor is not talking to you about taxes. You might have the wrong advisor. Okay, so now what we want to talk to you all about next is taxes and how they apply to the different accounts that you own, how money's taxed in and how money's taxed out. So we call this concept the tax triangle. Max, why don't you explain to the audience the tax triangle, how it affects their monies and distributions when it comes to taxes?
Yeah, so there are essentially three different types of accounts that you have traditionally when you're investing your money, and they all work completely differently when it comes to taxes. And the first side of the triangle, the first type of account, we call a taxed always account. The taxed always account is going to be taxed each and every year. You're going to receive a tax form, a 1099 at the end of the year, and you're going to have to pay taxes on it. It can be taxed at either capital gains or ordinary income. Just depends where it's coming from. These accounts are typically labeled in your name or individual accounts, or if you're married and you have a joint account, they're joint. So you think of, typically the account's going to have TOD at the end of it, or it's going to say JTWRS, which stands for Joint Tenants with Rights of Survivorship, basically meaning that if one of you were to pass away, the surviving spouse is going to take it over. But these accounts, they get taxed every single year. So if you have dividend growth in the account, you're going to pay taxes on the interest on the dividends. That's your ordinary income. If you sell an investment, you're going to pay the taxes on it at the end of the year at capital gains, whether it's short-term or long-term capital gains. But you're consistently getting taxed on it, and it's funded with cash investments. That's a very important piece to know about these accounts, is that you put cash into the account that's already been taxed, and then all of the growth that occurs is going to be taxed, whether it's through dividends or interest. That applies to CDs or money market funds at the moment if they're held in these accounts.
All right, so so individual brokerage accounts, joint brokerage accounts, CDs, money market accounts, or tax always accounts.
Yeah.
Okay.
All
right, what's next?
So the next side of the triangle, the other over here, is what we call tax later money. So tax later money is where most of the wealth, I would say, is held in the United States, because these are what are considered pre-tax accounts, which is, think of your 401k at your job or a traditional IRA. And we're not talking about Roth here. This is all pre-tax money. So the money goes in and it has not been taxed yet. So if you're contributing to your 401k and the money goes into the account before your taxes get taken out of your paycheck, that is considered a pre-tax account, or the tax later accounts. And with these accounts, you're deferring the taxes. You're basically kicking the can down the road. Once it's time to take money out of these accounts, you are going to have to pay taxes on whatever you pull out at your ordinary income.
Okay, so what you're saying is that, and I think most people know this, 401ks and IRAs, most people have a silent partner that's ready to, say, now it's time to pay me.
Yeah.
So this is, and then like Max says, this is where most people have their wealth. So again, one of our core competencies is tax mitigation. It's showing people how to unwind this problem and potentially reduce their taxes over their lifetime, so you can keep more of your money and less goes to the IRS.
Yeah, absolutely. Okay. And then the last piece up here is what we call tax-free money. Now, tax-free sounds great, but there are a lot of rules that you have to follow to make this money tax-free. But what goes in the tax-free up here is things like your Roth IRA or your Roth 401k, as well as life insurance.
And also municipal bonds too,
and
right?
Municipal bonds, yes. Anything that's going to generate, tax-free growth. And when you pull the money out, it will be tax-free.
Now, what are the rules around the Roth to make sure that the money is tax-free?
Yeah, so the rules around the Roth is that you need to have a Roth for at least 5 years. And that just starts when you open a Roth. So it's not like every Roth you open, you have to wait 5 years. It's just you've had to have a Roth for at least 5 years for then the growth to be tax-free, which I highlight growth because the original money that you put into the Roth, that is tax-free. You've already paid taxes to get it into the Roth. So you can pull out principal value from the Roth without any penalties or dealing with any taxes. But as long as you wait those 5 years in your Roth, the money, as all of the growth, the initial principal, everything will be tax-free upon distribution.
Okay. And you also have to be at least 59 and a half to avoid any penalties, right?
Yes, it is a traditional account. It's a traditional retirement account. So just like your 401k, your traditional IRA, the Roth falls into the same guidelines of you have to be 59 and a half to pull it out without any penalties.
Okay, so 5 years of penalties. So let's talk about life. So what about life insurance is a little bit different or unique?
Depending on how it's structured. And in this instance, we're structuring a policy that would have cash value accumulation. Cash value accumulation is, you put money in and it's going to grow inside the life insurance account that you can then pull out of the account and pay yourself a tax-free stream of income. But what also comes with life insurance is a death benefit, which is also tax-free. So if you were to pass away, your loved ones could then inherit a lump sum of money completely tax-free, as long as the policy is done correctly.
Okay. So like for us, if we want to have, for our clients that have, high net worth and they want to transfer wealth in the most efficient way, sometimes we advise them to do a Roth. Sometimes we advise them to buy life insurance. It just depends. Okay.
Yeah.
Now, so what's the next thing that we want to teach the audience?
Well, yeah, I want to just talk about getting money into a Roth and the rules that go along with it, because that is something that can be easily misunderstood. And so, Roth, when you're taking tax always money and you're putting it up into the tax-free, that's what's called a Roth contribution. So basically what you're doing is you are taking cash and you're moving it into the tax-free point of the triangle into a Roth. Now, a Roth contribution, there are a lot of rules that go along with it to make sure that you're allowed to do it. The first one is that you need to be working. You need to have consistent income, reportable income that can allow you to put the money into it. And you can only put into it, what you, however much you earn. So let's just say you're doing a part-time job and you only make $2,000. Well, then if you were to put money into a Roth, you can only put up to $2,000 into the account. You can't go, well, I make $2,000. I'm going to put $8,000.
But you have to be working. You can't take your investment income, rental income, none of that, and put it into Roth. You have to have reportable income.
Yeah, you have to have the reportable income there. And then there are also income limits. So the income limits means that if you earn a certain amount of money over the threshold, you can't put money into the Roth. So if you make too much money, you can't put money into the Roth. Yeah.
Wow. Who makes these rules anyway? Can we call somebody, complain to the manager? Too many rules.
Too many rules, and there's still more to come.
And I'll tell you what, ladies and gentlemen, I'm not a conspiracy theorist. I don't know if there's aliens. There's a few other conspiracies out there, but I will say that if you look at the way, like a lot of you who are listening to this have been saving for 30 or 40 years, you were advised to put money in a pre-tax 401k because you're going to get a tax break on your contributions, and down the road you're going to be at a lower tax bracket. Whoever said that must have had a crystal ball, because how would they know what tax brackets are going to be 30 or 40 years later? And then of course, Roth IRAs, the Roth came out in the late 90s. I think it was 99. BAM Advisory Group, we are unwinding a problem that's been around for 30 or 40 years. And if your advisor is not talking to you about taxes, you might have the wrong advisor. Click on the link below. Let's schedule a no obligation, no cost consultation, and we'll walk you through this tax triangle to see if there's some potential tax savings that you're not taking advantage of today.
So some other rules though with the Roth contribution is there are also contribution limits. You can only put a certain amount of money into this account in any given year when you're taking tax always money, or you're taking cash and you're contributing it to your Roth.
For those of you that are working, there are Roth 401ks, right? And you have those same contribution limits than your traditional, but you can see a lot of rules around the Roth contributions. Now, so let's talk to our audience about Roth conversions, because that's where, if you're really looking to move the needle, if you're really looking to get some of your wealth from taxed later to tax-free, Max is going to talk about conceptually what Roth conversions look like.
Yeah, so Roth conversions are completely different than the contribution. You're taking the tax later money over here and you're moving it up to the tax-free point of the triangle, because once the money's in that tax-free, it's not going to be taxed again. And by doing this, you can help potentially reduce future taxes that you're going to pay. Because tax later money, you're just waiting until you're forced to pay taxes. So what we do is we can help our clients do Roth conversions.
And again, ladies and gentlemen, you have to hold that Roth has to be held for at least 5 years before the growth is taxed again, just to make sure you understand that.
And so Roth conversions is taking tax later money, you're moving it to tax free. And we like to say, let's try to slowly divorce the IRS over time. I mean,
I think that's a divorce that we can all get behind.
Yeah.
Wouldn't you agree? Yes.
Absolutely. And doing this, it's not like you just want to say, well, I have X amount in my IRA. I'm going to move it all to Roth right now. No, what you want to do is you slowly want to do it over time, and then let that Roth build up. And what you're doing is you're basically mitigating the taxes by peeling little bits and pieces out of your IRA, your traditional IRA or your 401k. You're paying taxes on it now, which we are at lower tax rates that are most likely going to increase. I mean, I don't know, but I would bet that they are. You're paying taxes on it now so that it can then grow for a longer period of time tax-free.
So, yeah, ladies, one of that's unique about us is we just don't say do Roth conversions. We actually analyze this. We actually take your income, what you want to live off of, satisfy that first. And then if there's room in your tax bracket, let's look at Roth conversions. And then what we do is we model that out over your life expectancy and see if there's moving the needle. A lot of times there's tens and hundreds of thousands of dollars in taxes that can be saved. And sometimes Roth conversions don't make sense. So if you really want to take a look at your situation, dive deep, see if tax mitigation could be something that could save you lifetime taxes. Again, click on the link below, schedule a no obligation, no cost meeting with one of our advisors, and they'll walk you through this process and show you the value of this. Anything else on the tax triangle, Max, you want to talk about?
Oh yeah, just Roth conversions. There are no limits.
Under current law.
Under current law. Who knows what's going to happen in the future? But right now, today, you can move as much money from a tax later point up to the tax-free source into the Roth. It's just how much money would you rather pay now in taxes versus later? And the problem with paying it later is that your account's going to continue to grow. Tax laws are going to change. Taxes may go up, and you could essentially be putting yourself in a worse position. So why not take advantage of it if it's possible for you to do some tax planning now so that you may be living in a more tax favorable retirement for yourself?
Yeah, and remember, ladies and gentlemen, the current Tax Cuts and Jobs Act expires at the end of next year. And Max is right, we don't know, but with the $35 trillion plus that we are as a country, and the number one revenue stream of the IRS is tax revenue, there's a good chance taxes go up. Definitely take advantage. Give us a click on the link and let's schedule that meeting.
Thanks for watching. Don't stop here. Keep investing in yourself. Watch another video. In fact, leave us comments. We're all about maximizing the one thing that money can't buy, which is your time.